In 1637, a single tulip bulb sold for more than 10 times the annual income of a skilled craftsman. In 1929, people jumped from windows as their life savings evaporated in hours. In 2008, the global economy came within hours of complete collapse. History doesn't repeat itself, but it sure does rhyme. And right now, we might be writing the next verse. Throughout history, humanity has made the same financial mistake over and over again. We get greedy, we panic, we forget, and then we do it all over again. Every generation believes they've figured it out, that this time is different, that they've found a new formula for endless wealth. And every generation learns the hard way that the rules of gravity apply to money just as much as they do to everything else. Today, we're going to walk through nearly 4 centuries of financial disasters, from Dutch tulips to cryptocurrency crashes, from railroad speculation to housing bubbles. Each crisis has its own unique flavor, but they all share the same recipe: euphoria, denial, panic, and devastation. By the end of this video, you'll see the patterns that connect them all, and more importantly, you'll understand why the next crisis is probably closer than you think. Let's begin where it all started, in the Netherlands, with a flower. Picture Amsterdam in the 1630s. The Dutch Golden Age is in full swing. Trade is booming, money is flowing, and the middle class is growing wealthier than any middle class in history. And they want to show it off. Enter the tulip. These weren't just any flowers. Imported from Turkey, certain tulips displayed stunning patterns caused by a virus, creating unique, beautiful blooms that became the ultimate status symbol. If you had rare tulips in your garden, you had arrived. At first, only the wealthy could afford them. But then something interesting happened. People realized they didn't need to buy the actual flower. They could buy a piece of paper promising future delivery of a tulip bulb. These contracts could be bought and sold, and as demand grew, so did the prices. A skilled craftsman earned about 300 guilders a year. By the peak of Tulip Mania, a single Semper Augustus bulb was selling for 6,000 guilders. People were mortgaging their homes, liquidating their businesses, and borrowing money to buy tulip contracts. Taverns became trading floors. Everyone had a story about someone who made a fortune overnight. But here's the thing about flowers. You can always grow more of them. In February 1637, something shifted. Maybe someone tried to sell and found no buyers. Maybe reality finally set in. Whatever the trigger, prices began to fall. Slowly at first, then catastrophically. Within weeks, contracts that had been worth a house were worth less than an onion. Fortunes evaporated, families were ruined, and an entire nation learned a painful lesson about the difference between real value and speculative mania. But it wouldn't be the last time this lesson needed to be taught. Fast forward to London, 1720. Britain is dealing with massive national debt from years of war. The government needs a solution, and they find it in the South Sea Company, a trading corporation with exclusive rights to trade with South America. The company's actual business was modest at best. Spain controlled South America and wasn't exactly welcoming British traders. But that didn't matter. What mattered was the story. The South Sea Company sold a dream of unlimited wealth from exotic lands filled with gold and silver. The company's directors launched a brilliant scheme. They offered to take over England's national debt in exchange for shares in the company. Investors would get rich, and the government would be debt-free. Everybody wins, right? Share prices started climbing, and climbing, and climbing. Members of Parliament bought in, the King bought in, Isaac Newton bought in. As prices rose, the company released more shares, which people bought eagerly, pushing prices even higher. Even Newton, one of history's greatest minds, got swept up in the mania. He bought early, sold for a profit, and watched in agony as prices continued to soar. Unable to resist, he bought back in at the peak and lost the equivalent of millions in today's money. He later said, "I can calculate the motion of heavenly bodies, but not the madness of people." By August 1720, reality caught up with fantasy. The South Sea Company had no real profits to show. When a few insiders started selling, panic spread like wildfire. The bubble burst spectacularly. Thousands of families lost everything. The company's directors were arrested. The term bubble entered the financial lexicon. The lesson was clear. Spectacular promises require spectacular evidence. But would anyone remember? Jump ahead, 150 years to an age of iron and steam. Railroads are transforming the world, connecting cities, opening frontiers, and creating enormous wealth. America and Europe are in the grip of railroad mania. Banks and investors poured money into railroad companies, many of which existed only on paper. The Vienna Stock Exchange crashed in May 1873, but the real earthquake hit in September when J. Cook and Company, America's most trusted bank, collapsed. Why? They'd invested everything in the Northern Pacific Railway, a railroad that was supposed to connect the Great Lakes to the Pacific Ocean. The only problem was the railroad wasn't making money. It was burning through cash, building tracks through wilderness where almost nobody lived. When Cook's bank failed, panic swept through America. Banks folded like dominoes. The New York Stock Exchange closed for 10 days. Credit dried up completely. Railroad construction ground to a halt, throwing hundreds of thousands of men out of work. This wasn't just a market crash. This was the world's first truly global depression. It spread from America to Europe, from Vienna to London to Berlin. Unemployment soared. Wages fell. The depression lasted 6 years in the United States, even longer in Europe. Farmers watched crop prices collapse while their debts remained. Factory workers lined up at soup kitchens. Entire communities that had sprung up along proposed railroad lines simply ceased to exist. The world learned that when you build an economy on speculation rather than real demand, everyone pays the price. But the biggest lesson was still to come. The Roaring Twenties, jazz, prosperity, and the stock market reaching heights that seemed to defy gravity. America had won the Great War, and the good times would never end. Or so everyone thought. The stock market became a national obsession. Ordinary people bought stocks on margin, meaning they borrowed money to invest, putting down only 10% of the actual cost. If you bought $1,000 worth of stock, you only needed $100. As long as prices kept rising, everyone made money. And rise they did. From 1924 to 1929, the market tripled. Shoeshine boys gave stock tips, chauffeurs became millionaires. The economist Irving Fisher famously declared in October 1929 that stocks had reached a permanently high plateau. Days later, the market began to crack. On Black Thursday, October 24th, 1929, panic selling began. The following Tuesday, Black Tuesday, the market collapsed. In a single day, the market lost 12% of its value. Millions of dollars simply vanished. But the stock market crash was just the beginning. What followed was an economic catastrophe that would last an entire decade. Banks failed by the thousands, taking people's life savings with them. 1 in 4 workers lost their jobs. Those lucky enough to keep working saw their wages cut in half. Farms failed as crop prices collapsed. Families lost their homes. Shantytowns called Hoovervilles sprang up in every major city. The despair was incomprehensible. Children went hungry. Families split up so they could afford to survive. The suicide rate jumped. The Great Depression didn't just destroy wealth. It shattered the American dream. It took a world war and massive government intervention to finally end the Depression. And it taught the world that markets left completely to their own devices can destroy themselves. Unfortunately, memories fade with each generation. By the 1970s, the world had rebuilt, and America was booming again. Then, on October 6, 1973, Egypt and Syria attacked Israel, starting the Yom Kippur War. Arab oil producers, angry at Western support for Israel, made a fateful decision. They would use oil as a weapon. OPEC announced an oil embargo against nations supporting Israel. Overnight, oil prices quadrupled. Gas stations ran dry. Americans waited in lines for hours just to fill their tanks. The government introduced rationing. But this crisis was different from all the others. Usually, economic downturns meant falling prices and unemployment. This time, prices were skyrocketing while the economy was shrinking. Economists had a name for this nightmare: stagflation. Inflation hit double digits. $1 in 1970 was worth less than 50 cents by 1980. Meanwhile, unemployment soared. Factories closed. The mighty American auto industry got crushed by more efficient Japanese cars. The oil crisis revealed something terrifying. The entire global economy was built on a resource controlled by a handful of countries. And when they turned off the tap, everything ground to a halt. Families saw their heating bills triple. The cost of food skyrocketed since everything depended on transportation. Real wages fell for the first time since the Depression. The era of cheap, abundant energy was over. The 1970s taught the world that economic crises don't always come from speculation and bubbles. Sometimes they come from the real world, smashing into our assumptions about how things work. By the mid-1980s, the economy had recovered. Wall Street was back, bigger and louder than ever. The era of the yuppie, of Gordon Gekko, of greed is good. Computers were transforming trading, allowing for faster and faster transactions. One innovation seemed particularly clever: portfolio insurance. Using computer programs, investors could automatically sell stocks if prices started falling, protecting themselves from losses. What could go wrong? October 19th, 1987. That's what could go wrong. The market opened down and kept falling. As prices dropped, portfolio insurance programs triggered, automatically selling stocks. This pushed prices down further, triggering more automatic selling. It was a feedback loop of panic, executed at computer speed. By the end of the day, the Dow Jones had fallen 22.6% in a single session. It remains the largest one-day percentage decline in stock market history. Larger than any single day in 1929. Larger than anything during the 2008 crisis. Fortunes were wiped out in hours. Trading floors descended into chaos. Some thought it was the beginning of another Great Depression. The entire global financial system teetered on the edge. But something different happened this time. The Federal Reserve, learning from the mistakes of 1929, immediately flooded the market with money. They told banks to keep lending. They stabilized the system. Within 2 years, the market had fully recovered. The crisis was sharp and terrifying, but it was contained. It seemed like maybe, just maybe, we'd learned how to manage these crises, that confidence would prove dangerous. The internet was going to change everything. That wasn't hype, that was true. But the question nobody wanted to ask was, which companies would actually make money doing it? By the late 1990s, investors had decided the answer was, who cares? Companies that had never turned a profit were worth billions. All you needed was a website, a business plan mentioning e-commerce, and venture capitalists would throw money at you. Pets.com spent millions on a Super Bowl ad, despite losing money on every sale. WebN promised to revolutionize grocery delivery and burned through $800 million before collapsing. Companies went public with no revenue, no profit, just a dream and a .com address. The NASDAQ, heavy with tech stocks, quintupled between 1995 and 2000. Day traders quit their jobs to trade stocks from home. Books promised to teach you how to make millions in the new economy. The old rules didn't apply anymore, or so everyone believed. Then, in March 2000, the music stopped. The NASDAQ peaked and began to fall. At first, people bought the dip, but the dip kept dipping. The fall accelerated. Within 2 years, the NASDAQ lost 78% of its value. $5 trillion of market value simply evaporated. Dot-coms collapsed by the hundreds. Pets.com went from a $300 million valuation to bankrupt in 268 days. Entire office parks in Silicon Valley sat empty. Thousands of well-paid tech workers found themselves unemployed. The bust proved an old truth. Eventually, companies need to make money. Having revolutionary technology means nothing if you can't turn it into profit. Some companies learned this lesson and survived. Amazon nearly went bankrupt, but adapted and thrived. Most others simply disappeared. The dot-com bubble taught us that technological revolution doesn't exempt you from economic reality. But the biggest lesson of all was just around the corner. This is the big one. The crisis that brought the global economy to the brink of collapse. The crisis whose effects we're still living with today. It started with a simple idea. Everyone should own a home. Banks began offering mortgages to people who previously couldn't qualify. No income verification needed, no down payment required. These subprime mortgages were risky, but banks didn't care because they didn't keep them. Instead, they bundled thousands of mortgages together and sold them to investors as mortgage-backed securities. These bundles got sliced up and sold again. Insurance contracts called credit default swaps promised to protect investors if the mortgages failed. The system became so complex that nobody really understood what they owned anymore. Housing prices soared. People bought houses they couldn't afford, assuming prices would keep rising forever. They could always sell for a profit, right? Banks gave mortgages to anyone with a pulse because they were making money on fees, not on whether the loans would be repaid. Then, in 2006, housing prices stopped rising. Suddenly, people with adjustable rate mortgages saw their payments jump. They couldn't afford them. They couldn't sell because prices were falling. Defaults began to climb. In 2007, the cracks started showing. In 2008, the dam broke. Bear Stearns collapsed. Fannie Mae and Freddie Mac were taken over by the government. Lehman Brothers, a 158-year-old institution, filed for bankruptcy in the largest bankruptcy in American history. Panic swept the globe. Banks stopped lending to each other, unsure who was holding worthless mortgage securities. The credit markets froze. Major corporations couldn't get the short-term loans they needed for daily operations. The global economy was hours away from complete systemic failure. Governments and central banks launched the largest financial rescue in history. Trillions of dollars were spent bailing out banks and propping up the economy. It worked, barely. But the damage was catastrophic. 8 million Americans lost their jobs. 6 million lost their homes. Retirement accounts were decimated. The total economic output lost has been estimated at over $10 trillion. An entire generation saw their trust in the financial system shattered. The 2008 crisis proved that the global financial system had become so interconnected and complex that a problem in one corner could bring down the entire structure. It revealed that the people running these institutions didn't understand the risks they were taking. And it showed that sometimes the crisis is so big that only governments can stop it. Before the dust had even settled from 2008, another crisis was brewing across the Atlantic. The 2008 crash had forced governments to spend massive amounts to save their economies. But some countries had been hiding how much debt they really had. Greece was the first domino. In 2009, the new government revealed that previous administrations had been lying about deficit figures for years. Greece's debt was far worse than anyone knew. Markets panicked. Interest rates on Greek bonds skyrocketed. The problem spread. Ireland had bailed out its banks and was drowning in debt. Portugal, Spain, and Italy all faced similar pressures. These countries shared a currency, the euro, but not a unified fiscal policy. They couldn't print money or devalue their currency to ease the pain. Austerity became the word of the decade. Governments slashed spending, cut pensions, reduced salaries, raised taxes. The social fabric began to tear. Unemployment in Greece and Spain topped 25%. Youth unemployment exceeded 50%. Entire generations faced a future without jobs or hope. The European Central Bank and IMF provided bailouts, but with strict conditions. Protests erupted across southern Europe. Political extremism grew. The European Union itself seemed in danger of collapse. The crisis exposed a fundamental flaw in the euro system. Countries with vastly different economies and fiscal policies can't share a currency without accepting the consequences. Some countries wanted the benefits of monetary union without the discipline it required. By the mid-2010s, the acute crisis had passed, but the scars remained. Growth remained anemic. Trust in European institutions had been badly damaged, and the sense that the global financial system had been fixed after 2008 revealed itself as an illusion. Every crisis we've discussed so far had its roots in finance or economics. Markets got too optimistic. Bubbles formed, reality intruded, chaos followed. But the COVID-19 crash was different. It came from outside the economic system entirely. In early 2020, a virus spread from China to the world. Within weeks, governments faced an impossible choice. Let the virus spread unchecked, overwhelming hospitals and killing millions, or shut down their economies to slow the spread. They chose shutdown. And the economic impact was instant and catastrophic. In the United States alone, 20 million jobs vanished in a single month. The unemployment rate spiked from 3.5% to nearly 15%, the fastest increase in history. But this time, governments had learned from past mistakes. Central banks flooded the economy with money. Governments sent direct payments to citizens. Programs kept workers connected to their employers. The response was massive, immediate, and global. The stock market crashed 34% in weeks, the fastest bear market in history. Then, incredibly, it recovered just as quickly. By late 2020, stocks were hitting new highs even as the real economy struggled. This disconnect revealed something important. The stock market and the real economy are not the same thing. While millions struggled, invested wealth soared. The wealthy got wealthier. Working-class families suffered most. The crisis also accelerated trends that were already underway. Remote work became normal. E-commerce exploded. Digital services boomed while brick-and-mortar retail struggled. The pandemic didn't just cause a crisis, it restructured the economy. We're still living with the consequences. Supply chains were disrupted for years. Inflation roared back after decades of dormancy. The massive government spending, while necessary, created new economic challenges, and the social divisions deepened. So what connects all these crises? What's the thread running from Dutch tulips to pandemic economics? First, euphoria. Every crisis begins with genuine excitement about real opportunities. Tulips were beautiful. Railroads did transform the world. The internet did change everything. Housing is a real asset. But excitement turns into irrational exuberance. People stop asking, what's this really worth? And start asking, how much can I sell it for? Second, leverage. People borrow money to invest, amplifying both gains and losses. When prices rise, leverage makes you rich. When prices fall, leverage destroys you. Every major crisis involves people borrowing against assets whose value was based on optimism, not reality. Third, complexity and opacity. From South Sea Company accounting tricks to modern mortgage-backed securities, financial complexity hides risk until it's too late. When systems become too complex to understand, they become too complex to control. Fourth, the belief that this time is different. Every generation thinks they've learned from past mistakes, that new tools or technologies have changed the rules. They haven't. Human psychology remains constant. Fifth, contagion. In our interconnected world, problems spread faster than ever. What starts in one market or country rapidly becomes global. The 2008 crisis began with American subprime mortgages and nearly brought down the entire global financial system. And finally, governments and central banks have gotten better at responding, but that creates its own problems. Each rescue gets bigger, each intervention more extreme. We've avoided depressions, but we've also prevented the kind of cleansing that allows economies to reset. So where does this leave us? Are we due for another crisis? History suggests yes. It's been over a decade since a major crisis. Markets are at or near all-time highs. Debt levels, government and private, are higher than ever. New technologies from cryptocurrency to artificial intelligence are creating new opportunities for both genuine innovation and speculative mania. The patterns are there if you know where to look. Euphoria over new technology, leverage at extremes, complexity hiding risk, conviction that this time is different. But here's the thing about financial crises. They're only obvious in hindsight. Before every crash, smart people explained why it couldn't happen. After every crash, those same smart people explained why it was inevitable. The real lesson isn't to predict the next crisis. It's to understand that crises are features of the system, not bugs. They're the price we pay for innovation, for growth, for the dynamism of market economies. They're painful but necessary corrections when we get too far ahead of ourselves. What can you do with this knowledge? Stay diversified. Don't borrow more than you can afford to lose. When everyone around you is getting rich quick, remember that easy money usually isn't. And when the crash comes, because it will come, remember that it's happened before and the world survived. The markets will crash again. Banks will fail again. Politicians will promise it can never happen again. And then it will happen again, because we're human. We forget, we get greedy, we panic. We tell ourselves this time is different, but it never is. The question isn't whether there will be another crisis. The question is whether you'll be ready when it comes. If this video made you think, do me a favor, hit the like button, and subscribe to Histonom because I dive deep into topics like this every day.